S&P 500 entered correction territory last week, dropping by over 10% before recovering on Friday. Today I'll be showing 3 companies that I've been recently buying into in the past week in my £47,000 plus stocks and shares ISA. My reasons for doing so, how much I bought, and then finally carrying out a valuation and DCF on these companies to see if their future returns might be outperforming the market. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. My first buy this week was 1 share and just over £500 in the Dutch company ASML. This brings my total investment into this holding to over £4,000, totalling 8 shares. Now, for those that are unaware of what ASML does, they are a leading and effective monopoly in the development and manufacturing of EUV lithography machines that are used generally to create and develop chips. Now, their main clients include the likes of Taiwan Semiconductor Manufacturing Company, or TSMC, Intel, and Samsung. And then I asked Grog how much of ASML's revenues come from these customers, and it says they make up around about 65% of their overall revenue streams. About 31% coming from TSMC, so making them the biggest player, about 11% from Intel, and 23% from Samsung. Now, this may be considered a weakness on the part of ASML because they've got so much focus on 3 customers. However, in the past, these companies have actually invested in the company themselves to help them develop new technology that they can therefore use in future chip manufacturing. That happened with the EUV lithography machines. The likes of TSMC invested in ASML to help them manufacture and create those machines. So they have effective monopoly in this space, and they're the only ones that can now create these machines that we know of. So more recently, TSMC has actually announced plans to open new factories in America. And whilst they haven't really said any deals will be directly related to ASML, it's a fair assumption that ASML will benefit out of this new deal and new factories being made, because the machines have to come from somewhere, and ASML make the most sophisticated machines. Now, concerning its current valuation, I would say that at around about a minus 21% in the last year, they are looking attractive. It's not so much about what the share price is doing, but what the fundamentals are doing in the background. And they're around about $735 right now, and I've got a cost per share sitting around $712. Fundamentally, this company in price to earnings, historically, looks slightly undervalued. If we take a look at their 10-year analysis of 2015 price to earnings, we can see that the latest is around about 33 times price to earnings, and when I was buying them, they were sitting closer to 32. Their average over the past has been 36, which signals slight undervaluation, but the median line is closer to that number of 33 times price to earnings. However, price to free cash flow, on the other hand, is 27 times now, providing around about a 3.6% free cash flow yield. And over the past 10 years, this is trading well below the averages for this business. The median ratio for the price to free cash flow is sitting closer to about 40 times. So what this graph is telling us is that this price to free cash flow currently looks distinctly undervalued for this business. However, something to bear in mind for this one is that it is a cyclical business, and free cash flows can fluctuate quite a bit. Now, bearing those metrics in mind, we can try to see a good price to pay for this business. Now, I asked Grog what the expected growth of earnings per share for this company is, and they said around about 17% for the next 5 years. And I would happily assume around about 15 to 20% for the likes of ASML. If we use this on our DCF calculations, applying an earnings per share 5-year growth rate at around 17%, allow for them slightly buying back some shares throughout the years, a dividend growth rate of around 10%, and a price ratio that sits below what they're currently sitting at 30 times, we still get a CAGR of 15% on these conservative metrics. Now, the growth rate is the only one I wouldn't mind adjusting. So if we did change that, we still have a fair value of $947 here. But if we change it to a conservative 14%, we still get a market beta return around 13% and a fair value of $835 per share compared to the share price of $730, which makes this company undervalued in my opinion, and that's why I've been adding to this one during this down period. The next company that I bought into is one I've been adding to just a little bit, and that's S&P Global. It's an amazing business that I bought one more share of for just over £300, and the share price dipped just recently, just on the 10th of March, to around about below $480. So I snapped up one more share for just at the cost basis of $479 per share. And that's a level I would sort of be happy buying back into this company, because my cost per share in my ISA account is considerably lower at $419 per share. Now, in terms of what S&P Global do, they're effectively a ratings and analytics business that is exceptionally well placed as an effective oligopoly with the likes of Moody's and Fitch, which is a privately traded company. Now, effectively they rate companies' debt, and companies have to get their debt rated. They have no choice. That rating from S&P Global and Moody's is so important that the competition cannot match the fees that S&P Global and Moody's apply. Now, these two companies, even if these companies charge nothing, it would still benefit companies to go with S&P Global or Moody's, because that debt that they're having to repay gets lower interest rates from a ratings from the likes of S&P Global than it would from someone in their competitors. That makes it a very attractive business model. In terms of valuation, S&P Global currently trades at a price to free cash flow of 26 against the median over the past 10 years of around 30. So historically for this metric, this company is looking undervalued. We use this in our DCF valuation for this company. We give it a 5-year time horizon and give it a metric growth rate that sits closer to about 12%, because that's massively on the conservative side. We allow for them buying back some shares around about -1%, which they've started to do after a recent acquisition, hence this number here of 4.7% being so high, because they issued shares to make that acquisition. Then a dividend growth rate that sits about 10%, because that's what they're inclined to do more recently. And a price ratio for price to free cash flow that sits closer to about 28 times, which is a lot closer to the average for this business. Then we get a CAGR of about 14% over the next 5 years, a fair value of $597 per share, which is compared to the current share price around $494 per share. This is an amazing business that I couldn't resist snapping back up at a lower price than what it's currently trading at. Finally, we have a company that is probably my biggest position in my portfolio still, which is Amazon. Now, I added around about 4 shares to my position, buying around the $195 per share mark. This is despite having around about 25% of my portfolio in just this one holding already. The reason being, this company is currently trading at very attractive margins. I really like where Amazon is sitting for its future growth rate over the next 5 years. Currently, the company is trading around an operating cash flow of around 18. When I was buying it, they were trading at a price to operating cash flow of 17 times, which I think is very attractive for this business and how it is likely to grow those operating cash flows into the future. That's not really expensive, and it is such a high quality company. Historically, this company has traded at just over 26 times price to operating cash flow for the 10 years. Signalling slight undervaluation here on this metric. Now, I think it's undervalued because the company's capital expenditure and the likes of surrounding AI is so high right now, which makes price to free cash flow look unattractive and obviously overvalued. However, I believe this is something that won't really be around in the next 3 or 5 years after that, really. It will either come down to more attractive levels as they continue to reinvest and get a good return on capital, or they will consider it not a good bet and stop allocating so much of their free cash flow to it. And a lot of this operating cash flow that we were seeing here will actually be going to the bottom line of free cash flow, which is very attractive to shareholders. Bearing that price to operating cash flow in mind, we're going to try and look to see what a fair price to pay for this company is. If we do a 5-year time horizon on operating cash flow for Amazon, and we give an annual operating cash flow growth rate over the next 5 years sitting closer to about 13%, which is massively doable for this business and really on the conservative side if you ask me. Shares outstanding, we will allow them to continue to dilute shares. They have done in the past, so it is something that we should bear in mind for the future. And a price to ratio for operating cash flow sitting around about the likes of 20. The reason for this is because currently it trades at around about 18 or 17, and I think this is undervalued and unlikely to continue into the future over the next 5 years. All of that considered, we get a return of around about 14% over the next 5 years, which is market beating, and a fair value sitting around $234 per share, compared to the current share price of $195 per share. So this is a business I'm continuing to add to, despite it being the biggest part of my portfolio. And that reason is, among other things, this valuation. I do believe it's still very attractive for such a high quality business with so much potential. Now, moving on to more positive outlooks for growth, if we allow for about a 15% growth rate and a 21 times price ratio in terms of price to operating cash flow, both of which are still arguably conservative, we get a CAGR of about 17% over the next 5 years, which is really attractive and a fair value of $268 per share. I always prefer to be more conservative in my estimates, but I still think this is possible for the likes of Amazon. But thanks for watching, guys. I hope you appreciated this. If you get something out of it, don't forget to leave a like. Thanks for watching, and I'll see you in the next one.